All right. This is quick value number 277. United Natural Foods. UNFI is the ticker. This one's been talked about a ton on FinTwit for a long time, and I hadn't taken a look, and I finally got around to it. And I did it at a time where Kingdom Cap just did a really good podcast with Andrew Walker, so I recommend checking that out. My work is way less deep than that, so definitely take a look at that. So the quick backdrop: this is a 10-year chart for the stock, right? And the stock has been all over the place, from 50 to 10, 10 to 50, 50 to 10, and now 10 to, call it 30, just shy of 30. That's where we're at today. So the thing has been a roller coaster for this is just the last 10 years. And before that, it was a pretty steady grower, top line and bottom line for many years, right? For many years, this was a good organic growth story. And some really interesting things happen in the timeline, but we'll get to that in a minute. So it's about $28. Call it a 1.7 billion market cap. I think it's hanging around right around 6.5 times EBITDA, maybe a little bit higher than that, maybe a little lower. I don't know. I'm calling it a middle innings turnaround and deleveraging story. I think that's the general theme of this one. This is a grocery distributor, right? So it's an industry where there are distributors that do restaurants, distributors that do convenience stores, right? Like McLean sitting inside of Berkshire, Cisco and US Foods, they're big in the restaurant space. And then you've got the grocery distributors. And UNFI just plays in that space. Okay. And I don't think it's a really great business. Super Value was another big name in that space. And coincidentally, UNFI bought Super Value in 2018. Yeah, and that was that was a pretty interesting story back then. Super Value was, they sold the Albertsons thing, and they were selling off their retail stores and retail grocery stores, and they had this distribution business, and they sold that to UNFI. So Super Value was never a high multiple stock. I mean, it was always really cheap, and so I think UNFI will fit into that same category too. So Andrew Walker posed this really good question where he's like, I think these are potentially crummy businesses. Like, why should anyone have exposure to this? And it's a totally fair question. And I think it might be spot on. That doesn't mean that there's not still decent potential here, but I think that backdrop is important in that these may not be excellent businesses. So anyway, move on from that. Here's the history, kind of laid out the timeline. Pre-2018, it was an organic growth story. They levered up a bunch to buy Super Value in 2018. That period initially saw some solid performance coming into the pandemic for mostly pandemic-related reasons. After that, when the world started to normalize a little bit, in that post-pandemic timeframe, 23, 24, earnings went back to reality, and results kind of fell off a cliff. So then, fast forward to today, or maybe yesterday, 2024, management looked internally and said, "All right, we need to clean this thing up." There's kind of a newish management team that's in there. Definitely a new management team post the Super Value acquisition. And they're finally starting to clean house and get this thing right sized. So in 2024, they laid out a 3-year plan for fiscal 25 through 27. It's a July 31 year end or a summer year end. And that projection, or those financial objectives, had pretty good upside, right? Pretty good upside to earnings and leverage, not necessarily revenue, but to everything beneath that. So they were trying to clean up the margin story, post acquisition. So that's where we're at today. We're 1 year, just about 1 year into that initial 3-year plan. And by the way, you can see really clearly all those things I just talked about are like super evident when you just look at the 10-year trajectory of financials, right? Solid organic growth. Okay, here's the acquisition. EBITDA spikes, right? Pretty good performance in the first few years after that acquisition. They're feeling great, right? Margins are up, revenue, EBITDA, they're up. Oh, crud. Post-COVID, things are falling off a cliff. 830 EBITDA down to 518. Margins collapse by more than half, right? All of your earnings go away. Leverage is, 5x at close, hanging around 4, gets down to 2.5 and spikes back up to 4. So this thing's been all over the damn place. So that's the financial backdrop, right? So you can see that timeline of events pretty clearly in the financial statements. So looking at this turnaround picture in what they laid out, right? So the big components to it, I think, are they baked in flat revenue. So fiscal 25-27, they said no revenue growth, right? That was the general assumption, which is a pretty good conservative base case scenario. With that, they thought annual EBITDA should grow at a high single digit rate, right? High single digit rate from a fiscal 25 base of 550 million. And then at the end of this 3-year time frame, get to 0.5% of free cash flow margin, which is pretty, for a 2.5%-ish EBITDA margin business, is pretty solid performance. And then get net leverage down to 2.5 times by fiscal 27. So here's the whole layout of that 3-year plan. You can look it over, whatever. So this is what they set out in October of 24. Then we get through 3 quarters of 25. Here's the original. This is the initial projection, right? Flat revenue. Here's your EBITDA cadence, right? The fiscal 25 guidance, and then the high single digit growth rate through fiscal 27. Here's your free cash flow, right? Okay, we go from negative in 24, 100 million in 25, and then 0.5% of net sales by fiscal 27. Here's your leverage. Okay, so this is October 24. This is what we think we're going to do. Then we get 3 quarters in, and things are going pretty good, right? So revenue's growing. Looks like EBITDA is outpacing. Free cash flow is outpacing, and we're going to reach that net leverage target a full year early, based on the current guide. So this is pretty impressive progress on that 3-year plan, pretty early. So I see that and I'm like, okay, cool. I think that's good, because if you just did nothing but pencil out the upside for the original 3-year plan based on where the stock's at today, like that math pencils out to a pretty attractive situation. I get to 630 to 650 million of EBITDA, 1.6, 1.7 million market cap, leverage probably gets down to 1.6 billion or so. So you're getting this stock at like 5x that forward number, right? So if that's the case, in the original plan makes it an attractive situation, and they're outpacing that plan, then why are shares cheap, and why is it an interesting situation? I think a couple pieces. One, the balance sheet still needs some work. Here's the debt profile, right? So it was an organic grower with a pretty clean balance sheet pre-2018. Then they levered up to buy SuperValue, chipped away at that debt during COVID, and kind of stalled out recently. So they haven't made much progress, here in the last 2.5 years, 2.5 to 3 years. So now they're starting to generate cash again, and they are guiding to 2.5x leverage by next year. They're at 3.5x now. So that's a pretty big leap. So that means they need either significant EBITDA growth, maybe more than what the street is projecting, and not necessarily more cash generation than what they're doing in fiscal 25, which is $200 million. So that's a pretty big leap. So maybe there's some skepticism in reaching that 2.5x leverage target by next year, right? So I think that's one component to it. Second component to why I think it's hanging around where it is, they just had this cybersecurity incident. And I mean, it's a pretty big deal, right? 350 million to 400 million lost revenue, 40 to 50 million lost EBITDA. I mean, this is a pretty significant impact. And they're saying, they had an update call, gave everybody the numbers around it and everything, quantified it, said the operational impact is going to be limited to Q4, somewhere in here. I thought I had a slide. So Q4, here it is. Yeah. Expect the operational impact largely contained to Q4 fiscal 25. So cyber incident, and it sounds like things are contained, but we don't know. All we can do is take their word for it at this point. And they've quantified the financial impact of it too. So they gave us the revised outlook during that update call, and the EBITDA numbers look good still. The revenue numbers look good, and this is all including the cyber impact. So basically, if they're right, then fiscal 25 was looking really good compared to the original 3-year plan, and the fiscal 26 guidance, right? I think they have it laid out. Here it is. Fiscal 26 outlook is expected to be built on fiscal 25, excluding the impact of the cyber event. So, it sounds like fiscal 26 looks like it's shaping up to be a pretty strong year as well, if they're correct, right? If all of this stuff is believable. So where I shake out on this, I don't own any shares. I think it's really interesting, and I'm watching it, but the shares are flattish in 25. So underperforming the market, but they're not hugely beaten down. They're up 85% over the past year. So there's some credit being given to the 3-year plan. It's kind of performing, or the stock's kind of hanging around right where it should be, according to this 3-year plan, I think, in my opinion. And I don't think you want this to get to a situation where the street gets ahead of the plan. Like, I don't think you want them to bake in numbers that are more aggressive than what they originally laid out, right? Because that's just, a bad setup to execute on this thing. So I think it looks like the stock's kind of performing in line with where it should, according to plan. Like, things are just kind of moving along as they should. If they hit all of the targets that they've laid out, so assume 650 million of EBITDA by fiscal 27, 6 to 7x EBITDA, that might be aggressive. I don't know. I mean, I don't know what these grocery distributors are really worth. Super Value never traded at that. Like, I don't even know if UNFI paid that sort of multiple to acquire them. Assume net debt gets down to 1.6 billion, which is basically where you need to get in fiscal 26 for them to hit their leverage target. And let's just assume it stays there. That works out to $38 to $49 a share. It's a $28 stock today. So that's a 16 to 30% IRR. I don't know. And if they continue to outperform the plan, right, my 650 million EBITDA assumption is just according to their original 3-year target. So if they perform ahead of that, then maybe there's some upside to these numbers. So I think they're kind of checking the box, and it's just a simple execution story. There's, the cyber thing that they need to prove out that was a one-time thing and pretty contained. The leverage, we need to see that come down a bit from here. But, it's not like the stock is, let's take a look. This doesn't really do it justice. It had a big sell-off here, during that cyber incident, but it's still up a good amount over the last 1-year period. So I don't think it's like a screaming bargain today, but it looks like a pretty good setup if they can actually execute on this 3-year plan. Let's see. Do I have anything else that I want to look at? Here's my tables where cash is going. Cash is really going toward the debt right now. Fiscal 24, it was a year where they didn't really generate much cash. Cash was an outflow in 24, so they had to lever up to cover the cash shortfall, and now they're getting on the other side of that. Yeah, they started to change their reporting to give us. This was really like a natural / organic themed grocery distributor, right? They're trying to play in that space, not exclusively, but like have a bent toward that, which is a little bit of a faster growing category. So they lay that out and say, okay, well, the natural side of our business is faster growing than the conventional grocery store side of the business. So I think that's helpful. But what is that worth? This was a stock trading at, let's just see. I don't like looking at the metrics post the lease accounting rules because their enterprise value calculations are a little wonky now. But if you come back here, let's see. What was the historic valuation on this thing years and years ago? This shows it as a 9x EBITDA sort of business, and that was mostly the case pre 2018, right? I mean, this was a pretty high multiple stock at that point in time, and compressed a good amount after that. And these numbers all include operating leases and stuff, and I don't know, I don't include that when I look at enterprise value. So I think it's a little bit cheaper than that in this more recent period. But to think this was a premium price stock as it was growing, and then took a devaluation post that super value time frame. And you can see that pretty clearly. Like, here's your revenue growth trend. Let's just make this a column chart. Let's get rid of the super value time frame. Here you go. Okay, so I mean, look at that. This is your revenue growth. This is top line growth from 2003 to 2018. So pre-super value. Like, this is just a consistent organic grower, right? Deserving of a pretty significant multiple. So I don't know if it will get back to what it was before they made that acquisition, but just calling out, this is what the period was before, made this big acquisition. Now they're still climbing out of that hole. That's sort of the thesis that's at play. So I think it could have good upside if they execute on this plan. I don't know. It's on my watch list. I'm keeping an eye on it. I don't own it today. I don't know how much I love that grocery distribution space, but I think it's an interesting setup. If it got, if it puked a little bit from here, I'd probably be pretty interested in it, but would love to hear your thoughts. Let me know what you think. Check it out. Quick value 277, UNFI, United Natural Foods.